Okay, so let's get into this. The date is February 5th, 2026. And we're looking at a company that, it's been around since the telegraph was new tech, but somehow they're kind of rewriting the rules for modern finance.
We're talking about MetLife,
Exactly, MetLife.
the Snoopy company.
Well, see, that's the thing. If you're still thinking of them as, the Snoopy company or just the guys who mail you a dental card once a year, you are missing this huge, huge shift that's happening just under the surface.
Yeah.
They just dropped their Q4 2025 earnings. And it's not just a beat. This is a case study in how a 150-year-old dinosaur can evolve into a shark.
That is a pretty vivid image, but you're not wrong. We've got the earnings release, the full transcript from the call this morning, and the slide deck right here.
All the goods.
And the story here is really about this thing they call the new frontier.
Right, their big strategy they launched exactly 1 year ago.
And, usually when a huge legacy company announces a new frontier or a strategic pivot, you kind of roll your eyes. You expect a bunch of slick PowerPoint slides and not much else.
Yeah, a lot of jargon, not a lot of action.
But MetLife is actually doing it. They're fundamentally changing the physics of how an insurance company is supposed to work. They're moving from just hoarding capital to circulating it.
And we're definitely going to get into the mechanics of that. We were talking about things like sidecars and flow reinsurance, which sounds super complicated, but are actually these, brilliant bits of financial engineering. We'll also look at how a state law in Minnesota became this massive sales weapon for them and how AI is finally showing up in the profit margins.
Right.
But let's start with the basics, the report card. How do they actually do?
So the headline number is strong, very strong. Adjusted earnings per share, the EPS, it came in at $2.58 for the fourth quarter.
Okay, and that's up, what, year over year?
That's a 24% jump.
Wow. For a mature industry like insurance,
Yes.
That's huge. You usually see single digits from these giants.
It is. And for the full year, for 2025, they hit $8.89 EPS. But, and this is a big but, if you just glanced at a Bloomberg terminal this morning, you might have seen this gigantic red flag.
The revenue number.
The revenue number. It missed expectations by a massive margin. Wall Street wanted something like $31 billion. MetLife posted $18.6 billion.
That is a 40% gap. Normally, if you miss revenue by that much, the stock just tanks.
Right.
The CEO gets a very angry phone call. So why didn't the market completely panic?
Because in the insurance world, revenue it's a very noisy metric, especially right now. A lot of it has to do with accounting rules for derivatives and market swings.
So if they're hedging their risk, which they should be doing.
Right, to protect themselves from, say, interest rate spikes. The accounting rules might force them to mark that hedge down as a loss in revenue for the quarter, even if the actual cash coming in the door is perfectly fine.
So it's a paper loss, not a cash loss.
Exactly. The market saw through the noise and looked at the engine, the earnings power. And that engine is running hot, and it's because of this new frontier strategy.
And they've only been at it for a year.
Just 1 year. When they launched this, they set 5-year targets. We are 1 year in, and they have nearly hit all of them.
Okay, so run us through that scorecard. Because usually a 5-year plan takes, 5 years.
Well, they targeted a return on equity and ROE of 15 to 17%. They hit 16% in year one. They wanted a free cash flow ratio of around 70%. They hit 81%.
Okay, let's pause on that free cash flow number. 81%. That means for every single dollar of profit they report, 81 cents is actual liquid cash they can go do something with.
Essentially, yeah. And that is really high. It shows they're not just generating accounting profits, they're generating deployable cash.
And they're deploying it.
They are. They returned $4.4 billion to shareholders in 2025. That's buybacks and dividends.
So you get this picture of a financial fortress. It feels like no matter what the macro environment is doing, inflation, recession, whatever, they've just turned the company into a capital dispensing machine.
That's exactly the goal. The CEO, Michel Khalaf, he keeps talking about consistency.
Yeah.
But to really get how they're squeezing this much efficiency out of the business, you have to look at the individual segments.
And the how is different everywhere.
Exactly.
All right, let's start with the part that most of us touch. Group benefits. This is the insurance you get from your job.
Yep, the bread and butter. Dental, disability, life insurance. It's a fantastic barometer for the American workforce.
And there was this really counterintuitive thing in the dental business. We always hear that when prices go up, customers leave. It's Econ 101.
Right.
But MetLife jacked up prices on their dental plans to fix their margins, and people stayed.
They did. In fact, their persistency, which is just the industry word for customer retention, it actually went up.
How is that even possible? Are companies just too lazy to shop around?
It's not laziness, it's fear. It tells you two things. First, MetLife was probably underpricing the risk before, and the market knew it, so the new price was still seen as fair. But second, it tells you everything about the current labor market. Companies are absolutely terrified of losing good people.
Ah, so the HR director is thinking, I can't be the one who cuts the good dental plan.
Exactly. You're an HR director. The last thing you want is to cut benefits or switch to some subpar provider to save a few bucks. Employees notice that stuff immediately. In a tight labor market, benefits are incredibly sticky.
The stickiness of the benefit is higher than the price sensitivity. That makes sense.
Yeah.
But it wasn't all good news in group benefits. We have to talk about disability.
Right. Ramy Tadros, he's the head of U.S. business. He spent some time on this during the call. And he used two words that are basically the enemies of every insurer: severity and incidence.
Oh, could break those down for us.
Incidence just means more people are filing claims. The number of people getting sick or hurt went up.
And severity?
Severity means the cost or the length of each of those claims went up. So in Q4, MetLife got hit by both at the same time.
So is the workforce just getting sicker? Is this a post-COVID trend?
That is the billion-dollar question, isn't it? Tadros was very careful. He didn't call it a trend, he called it volatility. He pointed out that for the full year, recoveries, people getting better and going back to work, were actually strong.
So they're thinking Q4 was maybe just a blip, like a bad flu season, literally and figuratively.
That's their take. They aren't rewriting their long-term models just yet.
But while they're managing that, they seem to have found a gold mine in a place I really did not expect: government regulation.
Oh, you mean the paid family leave story? This is fascinating. I mean, it is a masterclass in corporate strategy.
So we're seeing more and more states. They used Minnesota as the big example, mandating that all companies offer paid family and medical leave, or PFML.
Right, and usually businesses hate mandates like that. It's more paperwork, more costs, more bureaucracy.
But MetLife loves it.
They love it because it's a wedge. It's a Trojan horse.
Explain how that works.
Okay, so a state like Minnesota passes this law. Suddenly, every small and medium-sized business owner is panicking. They don't know how to administer this stuff. They don't want the compliance risk. So MetLife comes in and says, hey, don't worry. We have a platform. We will handle the state mandate for you.
So they solve the immediate headache.
They solve the headache. But once they're in the door, they say, hey, since we're already setting up your payroll deductions for this state leave program, why don't we also add dental and vision? And hey, maybe some supplemental life insurance.
And the data on this was crazy. I saw a stat in the slide deck that, it blew my mind. For their January 1st sales, when they sold a PFML policy, it came bundled with an average of 4 to 5 other products.
That attach rate is just staggering. 4 to 5 extra products. That is the very definition of synergy.
They're turning a regulatory burden into a customer acquisition machine.
A funnel, yeah. It lets them be a whole health platform instead of just a commodity vendor.
It's brilliant. Okay, so group benefits is steady, thanks to these smart cross-selling plays. But the part of the call that really felt like we were in the finance of the future was the retirement segment.
This is where the numbers get really, really big. We are talking about the retirement boom.
And it's all driven by something called pension risk transfer, or PRT. Can you just, break that down for anyone who doesn't speak actuary?
Sure. So imagine you're a big old company like GM or IBM. You have these ancient pension plans promising to pay retirees for the next 30, 40 years. That is a massive liability sitting on your books.
It weighs down your stock price, affects your borrowing costs.
Exactly. You make cars or computers. You don't want to be a hedge fund managing billions for retirees. So you pay MetLife to take that headache off your hands.
You cut them a giant check.
A giant check. You give them, say, $1 billion, and MetLife says, okay, we'll handle paying your retirees from now on. You get to wash your hands of it.
And MetLife had a record year for this. Over $14 billion in PRT deals in 2025.
It's a booming market. But here's the catch, and this is so important. If MetLife just keeps taking on all these billions in liabilities, eventually their own bucket gets too full.
They have to hold capital against that risk. It slows them down.
It weighs them down, yeah. And this is where we get to the most sci-fi sounding term in the whole report: chariot re.
Chariot re.
I know.
It sounds like something out of Mad Max, but it's actually a sidecar.
That's the industry term for it, a sidecar reinsurer. Think of it this way. MetLife is driving the motorcycle. They're finding the deals, doing the underwriting, servicing the customers.
Okay.
But they don't want to carry all that risk on their own bike, so they put it in the sidecar.
And who's sitting in the sidecar? Who owns the sidecar?
Third-party investors. We're talking pension funds, sovereign wealth funds, big private equity firms. MetLife created Chariot Re as a separate company and moved about $11 billion of these liabilities into it and another similar vehicle.
Why would investors want to take on that insurance risk?
Because it's what they call uncorrelated. It doesn't move with the stock market.
Yeah.
If the S&P 500 crashes tomorrow, people still need their pension checks. The actuarial math doesn't care about a bad quarter for tech stocks. And big institutions love that kind of stability.
So MetLife loves it because
It frees up their capital, they get to originate the deal, they earn fees for managing the assets, but they don't have to clog up their own balance sheet with all that risk.
capital efficiency.
That's the name of the game.
It feels like they're shifting from being a warehouse for risk to being more of a pipeline for risk.
That is the perfect way to describe it. They are becoming an originator, and they're doing the same thing with annuities now. They're getting into the U.S. retail annuity market, but they're not hiring a huge army of agents. They're using something called flow reinsurance.
Which means?
It means other companies sell the policies on the front end, and MetLife just quietly takes a piece of the risk and the assets on the back end.
It's low drag way to get into the market. No
Right.
big overhead.
Just pure financial flow.
And this whole pivot, right, from holding money to managing money seems to be the central theme, which is a perfect segue to the next big move, asset management.
Yes. So for the first time ever, MetLife Investment Management, or MIMM, is its own separate reporting segment. And that is a huge signal to Wall Street.
What's the signal?
The signal is value us like an asset manager, not just a slow-growth insurance company.
And why do they want that? Higher multiple.
Exactly. The market pays a lot more for steady fee income than it does for lumpy insurance premiums.
And to really goose this, they just closed that huge deal for PineBridge Investments.
That one deal pushed their total assets under management, their AUM, to $742 billion.
Wow. So they're closing in on $750 billion.
That puts them in the big leagues.
Right.
And the strategy is what they call convergence. They basically believe the line between insurance and asset management is just disappearing. Well, think about it. An insurer needs to invest in long-term assets to match their long-term liabilities, things that pay off in 20 or 30 years, like infrastructure, private credit, agricultural loans.
Stuff that's hard to find.
Really hard to find. MetLife has spent a century getting good at sourcing those assets because they had to for their own portfolio.
And now they're just selling that expertise to others.
Right. They're saying, hey, we can find these for you too, to other institutional clients. They're targeting an operating margin in this segment of 32% by 2028. That is a juicy, high-margin, fee-based business.
There was one kind of awkward moment on the call about this, though. An analyst asked about Brighthouse Financial.
Ah, yeah, the elephant in the room. So Brighthouse was spun out of MetLife years ago, but MetLife still manages a huge chunk of their money. They're a massive client.
And Brighthouse is being acquired by another company, Aquarian.
Right. And the fear is that Aquarian will come in and say, thanks, but no thanks. We'll manage this money ourselves now.
Yeah.
And just yank billions of dollars away from MetLife.
It's a valid concern.
It is. But management played it so cool. They basically said, look, we have a contract, we have a good relationship, but even in the absolute worst case scenario where we lose all of it, the impact on our earnings per share would be very modest.
They just shrugged it off.
Totally. They're betting the growth from PineBridge, and new clients will more than make up for any loss from Brighthouse. It shows they're not dependent on one single legacy client anymore.
Okay, let's hop on a plane and go to Japan.
Mm-hmm.
This is a massive market for them, but the currency markets there have just been wild.
Volatile is an understatement, yeah. The yen has been bouncing all over the place against the dollar, and that created this really weird consumer behavior in Q4 that initially spooked some people.
The surrenders spiked. People were cashing out their life insurance policies.
It sounds terrible, doesn't it? Surrender is such a negative word. But in this case, it was actually a really smart financial move by consumers.
Yeah.
Because a lot of these policies they sell in Japan are denominated in U.S. dollars.
So if I'm a Japanese policyholder,
Right. So you hold this asset in dollars. When the yen gets really weak, that means the dollar gets really strong. All of a sudden, the cash value of your US dollar policy is worth a mountain of yen if you cash it out right now.
It's basically an arbitrage play. You're cashing out to lock in a currency gain.
It's exactly that. It's like selling a stock at its peak. So it's not that customers suddenly hate MetLife. They just really like making a profit.
Right.
And MetLife knows this. They pointed out that their actual sales in Asia were up 18% for the full year. So the demand is still strong.
And they mentioned a new solvency metric for Japan, the ESR.
The economic solvency ratio. It's a new regulatory standard. MetLife is projecting a score for themselves between 170 and 190%.
Which I assume is pretty good.
It's very robust. It just means they have a huge capital cushion in Japan no matter what these currency swings are doing.
All right, I want to pivot to the hidden levers.
Yeah.
The stuff that's not in the headlines but really changes the math. And there was an accounting change with their real estate that caught my eye. It felt a little bit like magic.
The nerdy but lucrative tweak, yeah.
Explain it to me like I'm a first-year accounting student.
Okay, so historically, when MetLife calculated their adjusted earnings, they had to treat their real estate portfolio, their office towers, their warehouses, like a delivery truck. They had to depreciate it, subtract a little bit of value every year for wear and tear.
Which drags down their reported earnings.
Exactly. But MetLife basically argued, wait a second, this is prime real estate. It's not a used car. It doesn't lose value over time. It usually gains value.
So they just stopped counting depreciation as an expense.
In their adjusted earnings calculation, yes. They argued it gives a much truer picture of the actual cash flow and economics of the investment.
And poof, instant profit.
Instant profit.
Yeah.
It added $57 million to their Q4 earnings, just like that. And they think it'll add about $200 million a year going forward.
Is that kosher? I mean, it feels like moving the goalposts.
It's allowed for a non-GAAP measure like adjusted earnings. Companies get to define adjusted as long as they explain what they're doing. And honestly, they kind of have a point. But it definitely helps make the growth chart look a little bit nicer.
The very convenient truth.
Very convenient.
The other big lever is AI, artificial intelligence. I mean, we hear every CEO on the planet talking about AI.
Yeah.
We're an AI-first company. But MetLife actually brought some receipts.
They really did. They pointed to their direct expense ratio. That's basically the cost of keeping the lights on. And they drove that ratio down to 11.7% in 2025, which beat their own target.
And they credited AI for that.
Yep. An efficiency mindset.
Yeah.
Using AI to automate claims, customer service, all the back-end plumbing. This isn't just some pilot program anymore. It is showing up on the P&L as lower costs.
There's a tension there, right?
Yeah.
They just bought PineBridge. Asset management is an expensive business. You have to pay traders. You need fancy terminals. Won't that just ruin their expense ratio?
It will. It'll bump it up in the short term. They admitted the ratio will probably go up to about 12.1% next year because of the acquisition. But, and this is the amazing part, they kept their 2029 target at 11.3%.
So they are betting that AI will be so powerful that it will more than offset the entire cost structure of a brand new expensive business.
That is the bet. They believe they can scale the asset management business without scaling the headcount at the same rate, all thanks to technology. It's a bold projection. But if they pull it off, it makes them incredibly profitable.
So when you step back and you look at the whole picture here in early 2026, you've got this financial fortress pumping out cash. You have the sidecars offloading the risk. You have the Trojan horse of state mandates selling more benefits. You've got AI cutting costs. What's the big takeaway?
I see a company that has successfully, inoculated itself against the typical risks of being an insurance company. The CEO, Khalaf, he calls it an all-weather company.
All-weather.
Yeah, think about it. If interest rates are high, great, their massive bond portfolio earns more money. If interest rates are low, that's fine. They can lean on the fee income from asset management and the steady group benefits business. If the economy totally crashes,
They've got the sidecars to absorb some of that shock.
they have hedged their own business model. They're not just sitting around waiting to see what the economy does to them. They have engineered a machine that can profit in almost any scenario.
Which brings us to the final thought. We always like to leave you with one big thing to chew on. And for me, I just can't stop thinking about the sidecar.
It is the most provocative part of this entire story. We are watching the platformization of risk.
I'll unpack that a little.
Well, for 100 years, insurance was a vault. You gave an insurer your risk, and they locked it away on their balance sheet forever. If something went wrong, the vault had to pay up.
Right.
Now, giants like MetLife are becoming more like pipelines. They originate the risk, the pension, the annuity, but then they pass a lot of it through to the global capital markets, to these sidecars.
So the risk doesn't stay with them. It ends up with a hedge fund or a pension fund in Canada, or a sovereign wealth fund in the Middle East.
Exactly. And look, it makes the system more efficient, it lowers the cost of capital, but it also means that risk is being dispersed into the shadows of the financial system. If there's ever a true global crisis, the one holding the bag isn't necessarily the big, stable company with its name on a skyscraper anymore.
It's riding in the sidecar.
And we might not know who's driving that sidecar until it's already crashed.
That is a pretty sobering thought to end on. Next time you see a headline about risk transfer, just remember, the risk never, ever disappears.
It just moves.
That's our deep dive into MetLife's Q4 2025, a financial fortress with a very new frontier. Thanks for listening, and we'll catch you on the next one.